Hello, everybody. Welcome back to the channel. All right, so today we had the Consumer Price Index report, or Consumer Inflation report, however you want to put it, came out, and I'm going to go over some of the details on that, what I think it means or how it's translating, whatever, and also want to talk about more updates on the tariffs, unfortunately. So if you guys haven't heard, we're still in that our tariffs on or tariffs off crap going up. So last I'd heard, Canada, or Ontario particularly, had decided they were going to back off on tariffs for oil, or no, what was it like? Yeah, oil or electricity. I can't remember. Electricity, perhaps. I'm forgetting on it. And then Trump and kind decided to back off as well, but now we're back on for tariffs. So I can't make sense of what really to expect from that. As long as this is going to be so clear as mud, whether we're on or off, it's really hard for investors looking for individual company stocks to know where to put their money. There was an update in the news recently how actually the raw metal suppliers, let's say like Alcoa, or the one that used to be called Alcoa, American companies that supply that are actually wanting tariffs. Because when their competitors are in other countries and they can offer it for a better price, it makes it harder on the American companies' business. So when the tariffs are getting enacted on their competitors but not themselves, it makes their own items more competitive and priced, and it actually bodes better for those companies. So this is where you don't want to get too caught up on tariffs are good or bad for the broader economy. They'll absolutely slow down the economy, but it doesn't mean we're going to go into recession, okay? Again, at the nuts and bolts level, or the micro level, some companies are going to benefit greatly from the tariffs, and others are going to suffer from the tariffs. We just, to what degree, what's the overall, is it going to go from fast growth to slower growth, or it's going to go from slow growth to decline? By the time we're all done with this, who knows? Too much unknown there. But anyway, let's go over the inflation data, and I'll kind of see what updates there is there, and then I'll give you my impressions on what that might mean for the broader economy. All right, guys, we're going to take a look at the BLS Consumer Price Index data that just came out this morning now. I'm going to try to get through this as quickly as I can. All right, so here's the month-over-month performance overall. February, actually 0.2% growth is right in the sweet spot that we want to be in. 0.1, 0.2%, I would say around 0.2-ish would be ideal, where we really want to see to keep the overall, the annualized inflation rate in the 2 to 3% range. So we had a nice change of pace there that it's going to help us as far as keeping the Fed from wanting to raise rates again. But, with the tariff behavior, the latest updates with the tariffs, I'm not convinced that the Fed will be in a hurry to decrease the Fed funds rate either. But at least we're in the right area where we want to be. It's just, if we can keep it there under good control, we'll be in really good shape overall. So we'll just keep watching that. All right, so here's the core and the overall. The red's the core, and then the blue is overall. Red, core, as you see there, is at 3.1. It's a little bit elevated, but it's not something I would have much concern with. You see it is down from 3.8% a year ago. Whereas overall, it went from 3.2 to 3.5 last year, but now it's down to 2.8, right in that neighborhood where we want to be. So, below 3, but above 2, anywhere in that range is what we really ideally want to see. All right, so let's get through the data here, break down the itemized details. I'm going to go month over month first, and then we'll talk year over year. All right, so month over month kind of gives us an idea of what's contributing the most or the least to the overall result. Food away from home actually is a little bit high. This is actually a positive omen for the economy, for the broader economy, because when people are pinching on money, they tend to stop eating out at restaurants so much, and they tend to start buying more grocery items and preparing their foods at home instead. So the fact that it's still up a little bit more strongly than we would call the ideal of 0.2, that's actually at least gives us some reason to be positive about the prospect of the longer-term economy, okay? So I'm not going to say that the economy is rosy with what's going on, but this is at least something to, like a silver lining, if you will. All right, so energy commodities are down minus 0.9%, and a lot of that has to do with oil prices. Let me show you that. So here's the crude oil chart. Back here in January 15, okay, right here on the close price is where I want you to be looking. It closed at 80.51. That was where it topped out at, and ever since it's been in a downtrend, working its way down. And okay, it's working back up today at looks like 67, 69, but yesterday it closed at 66, 62. So this is going to translate to lower gas prices, lower gas, oil, fuel, and motor oil prices. Okay, now energy services. This is still a bit of a problem there. Electricity and piped gas, or well, we could say natural gas there. Those have been a problem for a while there, especially the gas utility. Gas. Electricity, it had been a problem, but it looks like it's kind of a little bit up and down now. I don't know what all the things are that are driving that. Minus 0.4% in August when it's summertime is a little bit surprising to me. There's something else driving that then. But then went back up to 0.5 and 0.8 in the fall and actually got down to a really nice level here. A little bit on the negative side, but pretty flat overall there for 3 months in the wintertime. But now it's up a little more strongly. Is that because the weather in some areas of the U.S. are warming up or something else going on there? Natural gas. That's going to be our biggest issue right there. What needs to be done to control natural gas prices? Got to have more supply there, more than likely. This is telling there's too much demand and not enough supply. So what's causing that demand? And why is there not enough supply to keep up with it? That's something that can be worked on. All right, so next is used cars and trucks. Now, I notice how new vehicles are down minus 0.1%, but used cars are up 0.9%. And this is around the time when people are getting their tax returns in. So we got used cars. Used cars have been up a little on the strong side ever since September. So this was even before Trump got elected into office. So we can't really say that the tariffs are causing that. Maybe that is to an effect, to an extent. I don't know. But and I know that some of the car manufacturers are starting to bring some of their operations back to the U.S. because of the tariff activity. So, and that might translate to some higher costs as well. But now used cars, people are buying used cars instead of new cars, basically. So why is that? Might be that they still have discretionary income to spend. They're still getting their tax returns back, but they don't really want to spend so much on new vehicles. Why would people buy used? I would take a guess that they're not so optimistic about the longer term economy or their own jobs, for example, possibly. Just a thought. Now, apparel. This is another one where it's up strongly, but if you look at it from month to month over the time, it was up strongly in September. That was around the time when people go back to school, and there's normally a surge right there anyway. And then it came back down strongly because the surge ended, and now people are back to not buying any. And then it stabilized. And then it went down in January, a pretty strong amount, but February, it's actually up a little on the higher side. So I'd imagine people are spending their tax returns on used vehicles and apparel primarily from what it's looking like. Looking at everything else here, okay, transportation service is down a little strongly, so that'll help the overall number, but we don't want it to be too strongly down. We'd like to be under control. Looks like it's naturally a little bit more on the volatile side, though, overall. So what's behind that? That could actually be part of the fuel costs, too, because transportation services, fuel costs are a big part of that. But if it's costing the carriers less to pay for their, it costs them less out of pocket to haul whatever they're doing, like whatever freight is being hauled. You're going to have it can translate to cheaper rates that they can offer to the shippers as well. Okay, now let's look at the year-over-year numbers here. Again, anything above 3 is we're going to have some concern about. So right here, food away from home, it's actually still a little on the excessive side, but again, I'll take that. If anything's going to be up above normal here, I would say food away from home would be ideal because, again, that's telling that people have discretionary income that they're willing to spend. Energy, we already talked about that. Same with utilities. 6%. That's our biggest problem right there with as far as the outlier creating too much of a upward effect on the inflation rate. Also, transportation services, that's been up 6%, but again, that's also because of fuel costs. And if this trend will continue, this will come down pretty fast. So this might not be such a concern. Shelter, this is still an issue here. This is still a little bit elevated here, but not that bad. It's That's one of those. I'll take it. You can't have everything at 0.2%. All right, let's take a look at S&P futures and see how the market's reacting to all this news here. So we're up 0.65% since yesterday afternoon. We're at 56.13. Really, that's we're just recovering a little bit from the previous day. We were in that same neighborhood a day or two ago. So let me zoom in here. Now, we were up a high on February 19th, and it's been on a downtrend ever since. Closed at 55.76 yesterday, and so, of course, we're up some, but are we out of the woods yet? I don't know. I wouldn't say so. Now we're down below my 200-day moving average, so there's other stuff going on here that's contributing to that. Now I don't look too heavily at stuff, but let's see, it's consolidating in that area, so there's might be previous consolidation there, right here. And in August is where there was consolidation at that same price range before. So, and also some more here in July. Perhaps that could be where things are going on. There'll be some possibly pre-existing supply of buyers there from when it came up. Basically, when sometimes people have preset orders in here. So once it breaks past this resistance here and comes up here, it starts becoming possible support. So what happens is people will take their buy levels from, like, let's say, down here or here and move their price point up to here. And then that way, if the price comes back down to, like, right here, as you see there, in that neighborhood, when the price comes back down to that level, which ironically or coincidentally, whatever, the 50-day moving average was also there. Now it triggers a buy, and it'll come back. When it comes back up, they're looking for more gains, but there really weren't a heck of a lot of gains to be had there when they do that. This is where I say don't necessarily just put preset triggers in there, expecting it to come back down and trigger before it continues to rally up, because you see here, it's not always the case. Once it came down to here, we closed at 54.04, and it came up to 57.38. And that's in the neighborhood before it actually, basically when it triggered these buys. So that's why I don't put too much stock in following the technical charts. They can be useful in knowing where there's likely to be supply and demand of buyers and sellers, and where you might want to put stuff. But if you're just a little bit too low on your buy price that you're willing to buy, and then that can also be a problem there as well. Sometimes it's better to just go ahead and jump back in when you have an opportunity. Well, that's going to wrap for this one here. Summarize here. Inflation here is looking pretty good overall, I would say. I would not expect to see the Fed make any changes at all to the Fed funds rate when they meet. I think it's actually this week or next week. I don't remember the actual date, but it's this month. The Fed meets every 45 or so days to set rate policy. Tariffs going on here. I could see some arguments for raising the rates actually, but with this data that just came out this morning, it's also definitely a reason to not raise rates. With people losing their jobs, we really got to see what kind of trend gets established. I don't really envy the Fed, because there's any number of ways this could go, and it can happen pretty fast, and too fast for them to be able to react to it. So, again, I don't envy the job that they have. I wouldn't want to have to be the one ultimately responsible for that if it turns out they move a little too slowly, like they did back in 2022, 21 or 22, whatever it was, when inflation began to run out of control. All we can do is just play waiting game as far as these tariff games are concerned. Hopefully, there will be some kind of a little bit more consistency on what to expect from them, because once that happens, we'll see some more money poured into the markets then. Until then, individual stock investors are not going to be so inclined to put their money into companies knowing that they might be putting it in the wrong company. All right, so those are my thoughts on that. Share yours. Let me know what you guys think. And all right, we'll have another update for you guys whenever we can. All right, so yeah.